If you've been around a few cycles, you'll already know Bitcoin doesn't just move randomly. It puts in the biggest rallies when the macro conditions align correctly. And right now, macro's kind of lining up for us. I know there's some bumps in the road like Trump's tariff stuff, but the point being made recently in a post from eCoinMetrics with a chart showing Bitcoin price action compared with the National Financial Conditions Index, or the NFCI. Now, if you're not sure what that is, then stick around. So I'll explain it in more detail, the correlation, and try to look at the wider macro picture right now of how are financial conditions loosening and how will BTC react. So first, the National Financial Conditions Index, okay, the NFCI. The TLDR of the NFCI is that every time the NFCI dips deeply negative, indicating very loose financial conditions, Bitcoin rips. It's a pretty simple correlation. Guess where we are right now? Yes, deeply negative with the NFCI at below minus 0.5, a level not seen since the tail end of the COVID money printer era when markets had just gone fully degen. But we'll get into that in just a minute. Now, as for what the NFCI actually measures, I think it's worth taking a look at. So it's the Chicago Fed Index of data from 105 different indicators that show risk, credit, and leverage right across the financial system. So you're getting a very expansive snapshot here of the entire liquidity situation, with positive values indicating tighter than average conditions, while negative values shows looser than average setups. Tighter conditions means money's harder to come by. Looser conditions means money's easy. And for some previous examples of what happens when more liquidity is moving around in the system, well, let's dive into history a little bit here so maybe it can help us inform our opinion about what could happen in the future. 2013, a time of QE madness. Part of the Fed's post-2008 crisis strategy was to buy treasuries and mortgage-backed securities in order to inject liquidity into the financial system. And by mid-2013, the Fed's balance sheet was beyond $3.5 trillion as it flooded the markets with hot, fresh dollars and suppressed interest rates at the same time. Banks had very large reserves. Credit was easy, risk appetite was back, baby. And although Bitcoin was very much under the radar back in 2013, it still ran from below $13 to over $1,000 across 2013. So you can see how QE created exactly the kind of environment that Bitcoin tends to thrive in, especially as liquidity was coupled up with fading trust in fiat stability, basically what Bitcoin is built for. But let's fast forward to 2017, the global carry trade and US tax cuts. But before we break that situation down for you, if you're serious about trading, then you probably want to get some serious trading tools in your hands. Femex is the OG cryptocurrency exchange that delivers the tools you need. Trade all the top coins with very deep liquidity, lightning fast execution, and the freedom to trade from anywhere. That's right, doesn't matter where you are, you can trade on Femex. You might need a VPN in some cases, but it's available to everyone. Right now, when you use my link right here, you'll instantly be upgraded to VIP level 2. That means you're going to get a 50% discount on your maker fees for spot markets, 40% discount on your maker fees for futures markets. Huge savings if you're an active trader. You know how much that's going to add up. And it doesn't stop there. Femex is also offering up to $30,000 in deposit and trading bonuses for new traders signing up using my link. That's right down here. Go check it out. This is a crazy promotion. Don't wait. Get it today. Link right there. Thank you very much. So, 2017. It's crazy times, man. So in 2017, central banks were still holding rates low even as markets boomed. And the carry trade, that is borrowing in low interest rate currencies like the Japanese yen, it's really the carry trade, isn't it, the Japanese yen, and then investing in high yield assets, especially US equities, that trade was in full flow. Well, crypto was very much positioned as an experimental alternative risk-on asset class. In the US, the first Trump administration came out and slashed corporate taxes and triggered an optimism in equities and in tech markets, and financial conditions remained very loose right throughout the year. And as for crypto, well, Bitcoin has survived its post-2013 crash and was gaining a higher profile. ICOs got extremely frothy, altcoins were flying, things like XRP and Dogecoin went to absolutely absurd levels, and Bitcoin went from below $1,000 in January 2017 to nearly $20,000 by December, a 20x in 1 year just holding Bitcoin, fueled by speculative mania but underpinned by macro tailwinds. And then after that, we've got 2020 to 2021. This was a really crazy period. The government just pushing out stimulus checks, helicopter money all over the place, yield suppression, yields were so low it's crazy. The COVID era was without exaggeration the most liquidity intense environment we have seen. The US government passed over $5 trillion in fiscal stimulus, including direct stimulus checks to individuals who basically took that money and bought dog coins, man. The Fed cut rates to near zero and unleashed unlimited quantitative easing with large-scale buying of treasuries and mortgage-backed securities, policies which are still in place while actively suppressing yields to keep borrowing cheap. The yields did rise, though, when inflation started rising, while explicitly signaling that it would let inflation run hot, and it did, and it got real hot, which screwed everything up in 2022. So with retail traders stuck at home playing the markets, the Bitcoin price went from $4,000 in March 2020 to $69,000 in November 2021, a huge move that showed what Bitcoin does when the printers are turned on and when financial conditions are super loose. So, your historical perspective, what about now? What about 2025? It's starting to look pretty spicy again, guys. It seems like the biggest players agree, as Goldman Sachs has reported that looser financial conditions, they're here. And they've been playing out since April in particular, with this change connected to increasing equity prices, falling credit costs, a softer dollar, other factors too, but those are the big ones they cite. Well, Goldman's own financial conditions index has fallen back to levels last seen before Trump's tariff drama first kicked off, with a fall in the index again indicating we are once again in very loose financial conditions and that the loosening effect is in effect. And then there's another major factor at work, which is Trump's the big beautiful bill. It's the biggest, most beautiful bill. Some people say it's the best bill. They're going to call it the Trump bill. So the BBB may not be universally loved, but it's a fiscal beast of wild proportions. The key features being that it makes tax cuts from 2017 permanent, while juicing defense and infrastructure spending. I know what you're thinking. America really needs to spend more money in defense. Anyway, cutting social spending, all this kind of stuff, right? Forecasters estimate it's going to add trillions to the deficit over the next decade, and that deficit spending means essentially more liquidity in the financial system. Now, at some point, all this stuff breaks, the fat lady will sing, the cows will come home, and it'll all break the camel's back. And while the Fed may have wanted to keep the rates higher for longer, Trump is lining up Powell's replacement, who's going to cut rates. Fiscal dominance is becoming a reality. While at the same time, banks are getting eased with capital requirements. The Fed just did this. Banks can now hold even more bonds than before, which can equate into more lending, which means more money in the system. Private credit markets, by the way, also doing very well right now. All of this creates potentially a perfect storm for even looser conditions than we have right now, meaning risk assets are going to continue to react. Equities have been flying. In case you haven't noticed, new highs for the stock market. Every headline-driven dip gets devoured. Banks are setting up for buybacks and dividend hikes, and Bitcoin is just a few percent below its all-time high at the time recording this video. Plus, it's not just the USA. No, even the Europeans are getting in on it, okay? The European Central Bank, the Bank of England, the Swiss National Bank, cutting rates. It's actually at zero in Switzerland now. Even New Zealand's cutting its rates. I know what you're thinking. What's going on in New Zealand? They're cutting the rates, man. China easing its monetary policy. Plus, emerging markets are receiving capital flows again. And if you want to know what global easing synced with U.S. fiscal expansion looks like, then again, take a look back at 2020 when stocks and crypto were both gearing up into hyper bullish mode. So all in all, if you zoom out and you check the recent historical comparisons where conditions were similar to what we're having right now, and the conditions are set to get even looser, we seem to be entering a phase that echoes 2017 or 2020. In crypto, we've had really no retail mania yet, and nothing looks like a FOMO-powered cycle top. It could take longer than you think to get there this time. Maybe it's till 2026, we don't see it. But there are deep reserves of capital out there looking for returns in a world where real yields are falling, liquidity is increasing, and credit will get easier. Perfect storm. Yeah, Trump's tariff drama might spook the market short term, but look where we're heading. These are exactly the kinds of loose financial conditions that are rocket fuel for risk assets like Bitcoin, AI stocks, and dog coins. Thanks for watching.